Hello, everybody. This is going to be sort of a rambling video, but not really, because it's going to be my 10 things that I feel about the stock market. Now, the reason I say that is, first of all, it's kind of going to be rambling because I'm going to come up with 10 things, 10 opinions that I have about the stock market. And I'll come up with them as I go. I have a few of them in my head, and I'm going to say my own personal opinions about the stock market because that's really all I have to go by. I should do the disclaimer. I have absolutely no study in stock brokering or in finance, or my only knowledge about the stock market is my personal experience of approximately 20 years of investing in the stock market. You know, I've made some mistakes. I've had some luck as well. And I took an Economics 101 course back in college, and that was a while back, so I don't even remember most of the stuff. So my own personal opinions, this is all it is. So don't take this as truth or as even a qualified opinion. I don't have any. There's a lot of things I don't know about the stock market. I'm learning as I go, and I've learned a lot already as I go. I do some research on my own, of course, on the internet, and it's a lot easier to research companies and things now than it was back in the 80s, because the internet has made everything so much easier. So the first opinion I have is, in this order, I'll tell you what the least risk as compared to the higher risky investments in the stock market. The least risky, I feel, are mutual funds. That's been backed up. I mean, my opinion has some basis in what I've read from more qualified people than myself in that area. But so the least risk, as far as if you don't want to lose all your money, would be mutual funds first. Second would be name brand stock. Name stocks that have sort of a name that's recognizable. And sometimes these very big companies go bankrupt, so of course it's not a sure thing ever. Not even mutual funds are a sure thing ever, but a company that has an established name of many years would be the second in line for. Now, those stocks are usually not at their cheapest anymore. Their unknown companies are usually sold at less expensive price, but those are companies that have established a name for themselves over many years. It's a household name stock. Then the next in line would be stock options. Those are riskier than stocks. And then next, the last thing in the stock exchange as far as risk, high risk, where you could really lose everything, are penny stocks. And those are companies ordinarily that are brand new, don't have any name recognition. So do your research. Sometimes, occasionally, a penny stock might have the support of a larger, more well-known company or have a contract with a well-known company. So, I'm not saying they're all bad, but they're higher risk. Be very careful. My opinion, again, is that you have to be careful in particular. And if you're new to this, I wouldn't start with penny stocks, that's for sure. So that's my number one opinion about the stock market. My number two opinion about the stock market is don't freak too much about fluctuations day to day or even hour to hour. In my experience, stocks will go up and down, up and down, up and down. And the more you watch them, the crazier you make yourself. And again, if it's not a penny stock, don't freak out too much if the price goes down a few dollars and goes up. And, if it's less than $1 fluctuation, calm down. I would suggest not to go too crazy over it. Because the stock market is bipolar. Just like people can be bipolar, the stock market is bipolar too. It goes up and down, up and down, up and down. And if you're watching it every second, you're new to it, you freak out too much, and it's not good. So maybe look at your stock once a day, if that. If it's a well-known company and you've done your research ahead of time, maybe, when you finally decided to buy them, and don't even look at them for a week. Maybe once a month for, long-term investing. That's that. My third opinion about the stock market is there's always like what do you call that? A curveball. There's always a curveball. And what I'm talking about is companies will do things to maintain, whatever they need to do to maintain the stock price or to keep from going under. They'll do it. I mean, there are things, they'll flip things around, they'll split them, they'll reverse split them, they'll buy back shares, they'll peddle them out. It's just things that it's not like you go to the store and you buy a loaf of bread and you come home and you eat the bread, and it's like you know what you're getting into when you go out and buy a loaf of bread. You can buy a loaf of bread and you get home and you find out it's moldy. And then you could go back to the store and you could return it maybe, or maybe you'll say, it's cheap enough, forget about it. I mean, it's not, buying stocks isn't like going to the supermarket for a loaf of bread. So, okay, let's assume, we can compare it this way. You go to compare buying a loaf of bread to the stock market. Okay, you go to the supermarket, you buy a loaf of bread. Looks good, looks nice and fresh and looks good. And you get home and you open up and you realize it's moldy. Okay, now regular purchasing, in a regular market, you go back to the store, return it, or you switch it off for another loaf of bread. And now, if it were the stock market, the stock brokers will, or not the stockbrokers, maybe the company owners and the financial advisors and the financial people all involved in, they'll look at the loaf of bread and, okay, let's just cut off this part here. Let's cut off this side of the bread, the part that's moldy. Then let's change the packaging. Then let's, they do stuff to the stock to try to maintain the value and, or let's just throw out the moldy part and sell it at half price now. Or, let's buy another loaf of bread and we'll merge the two into one package. That's what you do to a stock that's what companies do to your stock to try to maintain it, to keep it from going under. And it's all legal. So don't think you've got a sure thing ever. Because, and if something's really inexpensive, okay, that'll be my number what am I on, 4? Or am I on 5 now? Maybe number 4. That was my next thing. Don't think that because it's cheap, you're safe. I mean, actually, like I said, penny stocks that are under $1, be very wary of those. Because you'll think, oh, it's inexpensive, and you don't think you can lose everything. But you can. So that's number, I guess it was 4. Maybe I'm 5, I don't know. So that's now number 5. Let me think here. See, now I'm running out of ideas because I said I would just do a rambling. Number 5 in the stock market, well, my opinion, research what you're doing. Research the company you're buying. Research if that's really, the company might have one name, but owned by another company. Just, look into it. Look at what the stock has done in the past. Check out the asset to debt ratio, which means a company might be highly in debt. It doesn't mean that it's going under. It could be that it's just bought out another company, so it's in debt because it's purchased another company. That doesn't necessarily mean the company is bad. It could mean that it's growing. So, look into that, see what companies, if there's a merger going on. Sometimes when companies are going bankrupt, they'll be bought out by another company, but the name will stay the same because the company that bought them realizes that although this company is going bankrupt, it's got a name recognition, so we ought to keep the same name. It's just owned by another company now, but we're going to use that name and, just kind of vamp it up a little and save the company, which is one company that comes to mind that has done that is American Airlines. It's been bought or it's been merged, or I think it's been bought out. American Airlines, as well as some other companies, were bought out by another bigger company. But each airlines is keeping the same name, just the bigger company is kind of saving them from going completely under. And another company is this company, Oneida, the flatware company, makes dishes and silverware. That company was in bankruptcy, and it was bought by another company, and now they're going to do a merger with another fledgling company, but they're going to keep the Oneida name because the company that did purchase them saw the value in name recognition. So that's not really an opinion. It's sort of just something that I've observed happens sometimes. That kind of goes hand in hand with the buying the loaf of bread and repackaging it and cutting off pieces. And that's sort of what they do to companies sometimes. But they'll also do other things like the one that really came out from left field. I mean, talk about a curveball that I had no idea was coming. Reverse split. That happened to me once, and I lost everything. And I didn't even know you could do that. And then a stock split is actually not something that's bad. If a stock splits, that'll be my number 6. When a stock splits, in my opinion, that means it's doing well because it's grown so much that it's split. It had to split in half, because the price was so expensive that the company said, well, if we want people to buy the stock, we ought to split. The current stockholders will split their stocks in half and give them double the number of stocks. Each stock will be worth half what it was before. But it sounds scary, but that's actually not bad. You just have the same as you did before. Just you have double the stocks, but each stock is worth half what it was before. But you have, so that's good. It's scary because it sounds like it's something bad, but that's actually good. and that makes the price more accessible to new investors. So if your stock splits, that's good, in my opinion. If your stock reverse splits, that's bad. That means the company is doing what it can to save itself, because it's like drowning and it needs to grasp at straws. So what it does is the opposite of a stock split. It gives you half the amount of stocks, double the price, because the price has gone so low that they're almost worthless. So they gotta squish it all together to make. So if you had 10 shares of stock, you do a reverse split, you now have 5 shares of stock that are worth more, because it's and then, but those of you who didn't have, the people who didn't have enough stocks bought, lose, because they may not even, if you're squishing all the stocks together to make them into one stock, but if you didn't have that many stocks to begin with, you might end up with less than one stock, and then you just kind of drop off the face of the, you just kind of dropped off. They just like, that's what happened to me once. I bought this penny stock. That's why I say penny stocks are so risky. I had absolutely no idea you could do a reverse split. I mean something, obviously I didn't do like I said, I don't have any kind of formal studies or whatever, but I mean, suddenly my stocks were gone because they squished all the stocks together. So the people who had enough stocks to squish were okay. I mean, they had less stocks, but they still had their money. But I had just a few stocks, and when they squished them all together, I didn't even have one stock. And I guess if you had less than one stock, they just got rid of you. So it disappeared because the stock had plummeted so much. And, if your stock is worth pennies to begin with, it doesn't really have room for plummeting. So if it plummets too much, you really have nowhere to go except zero. So, I guess I'm not really doing 10 opinions. I'm kind of just expanding upon some of the opinions I already gave. But I guess I was on about number 6. So let me think of another thing to say to you about it. Piggybacking. I've seen sometimes new companies are kind of associated with stronger companies. They may be risky investments because it's a new company, but they've got the support. You can when you do your research into the company that you're thinking about buying shares in, see what companies they're associated with. There may be people rooting for them, groups that have established histories, and they're not necessarily other stock companies. They could be investment companies or wealth management companies that have stock, of course, and also are sort of assisting them. Maybe that's something to consider if you do decide to buy a stock that doesn't have name recognition and it's not so expensive yet. I mean, Home Depot was once an unknown company. So if you are willing to take risks, still try to lessen the risk by seeing who's associated with the company, the history of, companies can start up, quickly. I could open a company today, and you have to reach a certain level to be qualified to be put on the stock market. I mean, but you're not necessarily such a great company just because you can sell shares of stock. Shares on the Wall Street, on the New York Stock Exchange or the NASDAQ. I think you can sell shares privately, now I don't quote me on that. I believe that any company can sell shares to private investors, but to go public, that would be the New York Stock Exchange in the United States, or the NASDAQ in the United States. Other countries have their own stock exchanges, but I'm talking about United States. To go public, you have to have achieved a certain level of you have to qualify to trade publicly. Not, you could still be a fledgling company, but you have to have something. But you're still, it's very high risk. Well, this is for the women out there, which I know how you all think because I'm a woman, and I know not all women. I don't want to generalize. Not all of us think this way, but women. Mostly I'm talking to you because you know what I'm talking about. Don't buy a stock because you think it's cute. It's got a cute name, or it's, penny stocks can be very cute. I think that's part of their allure. And they're the riskiest stocks you can invest in my opinion. Again, I'm not a qualified person to be giving official opinions, but from what I've experienced, don't buy cute stocks, cute names and cute penny stocks, and don't do that. That's not a wise investment decision. You might get lucky, it's happened, but don't. Or if you're gonna do it, don't invest too much. Buy a few. Or be willing to lose everything. Yeah, I've had a bad experience with penny stocks. That's why I guess I'm focusing on that, Okay, that's another suggestion. Number 9, if I'm even on the right number. I think I run out of things to say. I mean, without getting too deep into it. I mean, I could go deeper into stuff I've done. I think I've said the main stuff. Okay, I guess this is going to be 8 opinions about the stock market for brand new investors who don't know anything. If you're someone who knows a little more, you maybe have a degree in finance and all that stuff. Obviously, this is a stupid video for you, but this is how people who don't know anything about investing in stocks think, because I was like that, and I'm still kind of like that. I'm a little better than I was because trial and error. But it's very interesting. I might get more into detail in another video and go over each of the points in more detail. But based on my own personal experience. So I really wish I could have gotten to 10. I probably should have planned this video a little bit more, but the higher the risk, the higher the return. I guess I could say that if I haven't already. That's something you've probably heard zillions of times. But the higher the risk. Again, you could lose everything. It's like gambling. One time, though, I got so lucky. Not with the stock market, though. I went to because I don't gamble. And even in the stock market, which is sort of like gambling, I'm very conservative about how I go about it. I think in long term, okay, that'll be number 10. And then I'll tell you the little story I was going to tell you. In my opinion, it is better to hold on to stocks for the long term rather than buy, sell, and try to make a quick profit. But again, I guess it's not really another opinion, because I sort of said that when I said don't freak out because the stock market fluctuates a lot. But that kind of goes in hand with why you got to stick it out for the long term. And, try to, watch what it's doing, keep up to date with what the company's doing. And now, if there's a crisis, stocks will plummet many times. The economic crisis we had recently in the past few years, some stocks went, plummeting. A lot of the stocks in retail went down. Macy's went up. Macy's did better than ever. 52-week highs for a while the other retailers were losing value. All right, things are evening out now. Now some retailers are starting to go up again, and Macy's is going up a little bit now too, not as quickly as it was before, but it's sort of like it absorbed all the shoppers, I guess. They were smart about how they appealed to different markets, different income levels. So anyway, I was going to tell you my little story about gambling. I don't go gambling ever, hardly. But a few years ago, I went to the horse race track. And it was I really went just to see the races. I wasn't going to gamble. I don't ever go. And I thought, oh, that might be an interesting activity to go to today. Watch some horses running around. And I went. And it was fun, watching the horses at first. Like the first race was pretty. The second race was, beautiful. The horses are so gorgeous running around, and the tracks and the jockeys going so fast. But, I was seeing the people around me gambling, and, they would go to the desk and buy some things. And I started looking at the board, because you would see what horse was good in what type of track and his record, it is sort of like the stock market. You could see the horse's history, how many races he'd won in the past, and if he likes to run on mud or if he's better on grass, and who the jockey was. And they gave you all this information, and people who know a lot about horse racing knew that, oh, okay, this and that, and they saw how many people were bidding on that particular horse. So obviously, if more people are bidding on the horse, he has a probably higher likelihood of winning, but each person is going to win less money. It's like buying a lotto ticket, and if a lot of people win, you got to split the winnings. So it was a less risky bet, but you had a better chance betting on the popular horses. So, people were doing all that stuff. And I went up there, and I didn't know anything, because I'd never bet on a horse before. And I just looked at one, name. Again, this is how I used to pick in the stock market. Well, he's got a cute name. And I picked the woman, the jockey was a woman. And since I'm a woman, I said, oh, that jockey's a woman. All the other jockeys were men. Well, they had men's names, so I assumed they were men. I said, oh, that's a woman jockey, and I like the name of the horse. Okay, I'm going to pick that one. And I bet $1. Nobody bet on that horse. Apparently, it was like the horse that was like the worst horse to bet on, because he was going to lose for sure. Anyway, so I bet on that horse $1. I said, I know I'll probably lose. I don't know what I'm doing. So the horse won. That horse won that race. And I was like, oh, wow, my horse won. That's nice. I went back to the desk, because like right away after you win, you go back with your ticket that shows you bet on that horse, and they give you whatever you earn. So I said, okay, here's my horse. And the lady gave me $30. So I bet $1 and I won $30. So that was awesome. I mean, it was awesome. But then, of course, I was mad, because I said, I only bet $1. If I would have bet $100, I would have won $3,000, that means. Or if I would have bet obviously I didn't even have $1,000, but if I would have had $1,000, I would have won $30,000. So there was a 30-to-1 bet. I mean, the odds were just completely so awesome. So that's my story. But I only bet $1, so I actually won $29, because it was the dollar that I invested. So that was the return on investment. If this were the stock market, my return on investment was $29. And then, of course, after that, my ego grew, and I said, oh, I'm good at this. And I bet a few more races $1, and I lost all of those. So I really only ended up winning probably, let's say, I don't know, $24, $23, because I lost on all the races after that. So, just because I got lucky the first time, it was beginner's luck. Don't think. So that'll be my final suggestion. Don't think just because you earned some money once on the stock market, that you're going to do that well all the time. Okay. So maybe next time, if you like this about the stock market, let me know. And maybe I'll do a little more explaining about more things that I've learned over the years. Always bearing in mind that I have absolutely no qualification to be giving opinions or stock picks or anything like that. Although I could tell you what stocks I'm looking at if you're interested. Okay, thanks for listening. Bye-bye.